Hey, it's Soleil, and this is episode 43 of the Red Pilled Orange Pill Investor. And today, MicroStrategy is up again. It's definitely cleared my. Oh God, it has cleared my 660 strike up from like 625, 630, I think when I sold it. I think I gave about $30 in upside. So yeah, it would have been around 630. So it went it went from 630 to 660, and then another 60. And so I'll get the 2 grand, and whoever bought this covered call from me will get the other 6 grand. Yeah, and that's completely fine. Which is actually uh, one of the things that I like the most about selling covered calls, because it seems like it's the only stock play where both parties can profit. So I profited 2 grand. This other person's going to profit six. Now, do I wish I was the one that profited the six? And I always want the most, and I want to gain the most and lose the least in every trade. However, it doesn't matter if I got six and the other person got two. When you sell a covered call, you own a stock that's worth 630, like I did, and then you sell a covered call against it for 660. I'm guaranteed to get this 2 grand. That's immediately available in your buying power. You can withdraw it to your account. You can use it to buy other shares of stock. You can buy options. You can do whatever you want with the money. And the other person paid the 2 grand, but then he's going to make six. So I guess technically he's going to make four, because he paid two and he can sell it for 66. So he made 4,500. So, but I also gained the upside. So I got paid 2 grand here, but I also got the $30 in upside from 630 to 660. So I actually got 5 grand, and I just remembered that. So I got five. This guy's going to get 65 minus the two. So actually, I ended up making out a little bit better in this deal. So, but it was pretty close to 50-50. And there may be other ways to create contracts where both parties profit. I'm just not aware of them. So I really like it as an ethical thing. So, if you buy stock from someone, then the price either, it can go horizontal and neither one of you made anything, but it's either going to go up or down eventually, and one person is going to have regret because if it goes down and you bought it, then you're going to be like, ah, shit, I bought before it dipped. And if it goes up and you sold it, you're going to be like, oh man, I didn't sell at the top. So I really like the covered call philosophically as an ethical transaction. But on my other account, I did go ahead and close out one of the covered calls and then sell off the shares. And I reinvested some of that in some mining stocks. And the reason I did this, I'm not a big technical analysis person. It's not that they can't work. I just don't have the time for the benefit involved. And so if this is a potential double top, then I did not want to suffer going to 500 again. And I don't think, because I had to buy back the calls from last week for so much, I didn't have enough buying power to survive that. So I was able to take some profits here, and I still have, I didn't sell all of my MicroStrategy off, but I was able to take some profits here and then be safe if there's another dip, and potentially even be able to, buy back cheaper. But if it does continue to go up, that's completely fine. I'm happy with the size of my my MicroStrategy, and I also have some here. But I ended up with a bunch of buying power on this account as well because MicroStrategy went so high, and I decided while Tesla was still relatively cheap, in my opinion, I went ahead and bought a Leaps for next January, and then sold a covered call against that. So this is a poor man's covered call, and you can buy the Leaps separately. So you can just go in and buy the long option. I bought the 150. I think the delta on it was, it was close to 0.8, so 0.78. I've gone as low as 0.7, but if the price of the stock drops, you can get yourself into trouble that way. If the price drops, you're in trouble, period. However, we'll see how this does. But I went ahead and just created it as a 2-option strategy. If you do, there's ones that actually have special names, and depending on what you've combined together. But this one, paid $6,000 for it and got paid $1.76. So got about 3% ROI on what it cost me. So 1% of $6,000 would have been 60, and I got just about 3 times 60. And also have call away value up to 197.50. I think that Robinhood will show you a little graph when you put this together, and it'll show you how far Tesla has to fall before you lose money, and how this would have to go up to like 260 by next Friday in order for me to technically lose money, meaning that as the price of so the delta on the Leaps was like 0.78. So every time the price moves $1, that one's going to move 78 cents. And every time the price of Tesla moves, this covered call is going to move at 0.19. And the hard part about that is I forget what it is. It might be Gamma. Maybe Gamma or Vega. I can't remember. But then as the price changes, the delta is also going to change. And at some point, once the price of Tesla were to get over like 260, the price of the Leaps can no longer catch up to the price of the 197.50 call. And so I would technically start to lose more money on the covered call than I would be gaining on the long call. But it's a pretty wide margin, and as long as you have a long call that's fairly deep in the money, so around 0.7 is a little iffy. Some people like to go to 0.9, but the higher your delta, the more expensive this is going to be. And the point of me doing this is because I didn't want to pay full price for Tesla. If I wanted to pay full price for it, I would just buy the shares. So as long as Tesla continues to trade sideways or somewhat up, it can go up quite a bit before it would technically hurt me. And it would have to go up insanely in a week for it to actually hurt in a meaningful way. But going down would be painful. It can go down slightly. That's not a big deal. And but anyway, I'm trying to be way more cautious about doing these because I was very heavy into it when I got completely wrecked at the end of year before last. And so I don't mind this being a very small part of my portfolio, but you know, and especially since Tesla just had their earnings, right after earnings, implied volatility collapses, which the price of the options generally decreases as well. So that means that the price of my leaps, the $6,000 I paid, will be a little bit cheaper than it would normally be. But it also means that the covered calls you're selling are going to be a little bit cheaper. So you're not going to make as much on a covered call. You're going to get this for cheap, but not make as much on the covered call. So that is kind of a wash. That just kind of works itself out. However, over the next 3 months, getting ready for the next earning call, implied volatility increases, and you'll be able to potentially get a little bit of bump on your leaps, as well as the premium that you'll be able to get selling the covered calls will increase as well. So you're getting the leaps cheap, and then over the next 3 months, this particular strategy should become even more attractive. So added one of these, and it's the only one. It's the only poor man's covered call that I have on this account. I have one for Tesla on my IRA. So you can't use margin in your IRAs, but you can purchase long options calls if you get approved, and then you could sell covered calls against those, which would let you be leveraged. But again, the dangers of being leveraged long is when the price goes down, you're leveraged. you're leveraged towards the bottom, so you can lose staggering amounts of money with these leaps in a very short period of time. For example, so the delta on this means the price is going to move 78 cents for every dollar that Tesla moves. So if Tesla moves down $50 and you owned 100 shares of the stock, you'd lose $5,000. But you'd still own the shares, and then you could just sell more covered calls, and you know that would just be fine. And then you'd hope the price goes up eventually. However, if the price of Tesla drops $50, the price of this option is going to drop approximately 80% of that, so approximately $4,000. But the damn thing is only worth $6,000 to begin with. So whereas owning the shares, you're going to lose about 25 to 30, maybe 30, no, sorry, between 30 and 40% of your value. You're going to lose $4,000 out of $6,000, so you're going to lose 66% of your your value. So these leaps can self-destruct very quickly. I don't give financial advice. I'm not a financial advisor, but if I was, I guess I would tread lightly around these. And I do tread lightly around them for myself. And so hopefully that explains why I don't just do this exclusively. Like, oh, hey, you can get a bunch of cheap leaps and sell a bunch of covered calls against it. Yes, you absolutely can. However, you can get completely wrecked when a small move in your stock just absolutely crushes the value of your leaps. But went ahead and added that. And then so for next week, what I'll do is I'll just close this portion of it. So, just click buy to close, and whatever the value is, you'll just close it. And then once that is closed, then you're free to sell another covered call against your leaps. And depending on what the price is, I'll just choose another suitable strike price that is generally around 70 to 80% chance of profit. I don't terribly like the way that Robinhood does this, but it's fairly close. Like if you have 85% chance of profit, it's going to approximate the delta, which you have to subtract from 1. So this is a point, subtracting 0.2 from 1 leaves you 0.8, and 0.8 is approximately the 84% chance of profit. And but this is just all predictions. This is all just a formula calculating this, what it thinks your chance of profit is. And but even on MicroStrategy, I chose something that was around like 80% chance it'll be 660, and then it's only Monday, and the price of MicroStrategy is already 720. So this means nothing. It's just a guide. It's just a tool to use. So that was my activity for today. Sold off some MicroStrategy for profit just in case it comes crashing back down, but left enough active that especially, so I worked a lot with some momentum traders in the past, and once you start setting 52-week highs, you have a chance to really have a run. And so maybe I was a little bit too chicken by taking some profits here, because if this really gathers momentum and people are like, oh wow, this is setting 52-week highs, there could just be a pile-on effect of people pumping this. There's no guarantee that will happen, which is why I really didn't take any profits here, and I think maybe that's what's got me feeling a little bit of PTSD from it. And so, but that's just par for the course too. So I didn't take profits here and should have, and so now I'm remembering this, and I took profits here. And Murphy's Law says that now it'll just pump for the next 6 months or whatever. And so that would just be perfect. The stock market, I think, well, how does it go? I can't even try the quote, but basically they say that the stock market will always react in the way that causes the maximum amount of pain, something along those lines. So that would just be the perfect scenario, is if I should have taken profits here and didn't, and then I took profits here and shouldn't have. But there's an old penny stock trader that I used to follow. I think he's deleted his account, Quick Fingers Luke, and he basically said you always participate in the bounce. So every time something pumps, you have to take profits. And so I violated that principle here and kind of paid for it, and it's still fine here. If I follow the principle here and don't make as much money because MicroStrategy pumps and pumps and pumps, that's completely fine. And like I said, I reinvested some of that money in mining stocks, which will also pump if this pumps, but it just won't. They're not levered. They're not leveraged Bitcoin plays like MicroStrategy is. So that's another reason why I feel comfortable doing it. Is this pumped, so I took profits in the leveraged asset and moved it over into another asset that's not leveraged, but will still benefit if this continues to pump, but will not, since it's not leveraged, will not crash as hard as MicroStrategy will if this does double top and then come back down. I don't really do technical analysis. I don't necessarily buy into it. I don't really use it for a lot of my trading decisions, but in this case, I just thought to myself, okay, if it does double top, I would be in a bad spot if this crashes back down to 400 or 500. And if it doesn't double top, taking some profits here won't hurt me. So in that sense, it just was the logical thing to do, and I did it. All right, I think that's a good place to leave it. Be good, y'all.